So, in the last video, we looked at the first few transactions for this fictional company, Looper Company. So what we're going to do now is pick up with September 9th. So on September 9th, it says we purchased merchandise inventory on account from Terran Company, 4,000, terms are 310 net 30, FOB destination. So remember that when we purchase merchandise inventory on account, okay, there's often terms. And these terms will include, okay, what our discount is, if any, okay, and when it's due. It also will probably tell us who's responsible for freight. And we know that with freight costs, okay, if it's FOB destination, it means that the seller is paying the freight. So what we're going to do is we're going to debit inventory for 4,000. And we're going to credit accounts payable for 10. All right. Now, one of the things that we neglected to do in the first video, okay, was do the cost of goods sold entry for the sale to Houston Company. When we use the perpetual method of inventory, every time a sale is made, we need to debit cost of goods sold and credit inventory, because under the perpetual method, we're keeping a real-time recording, a real-time balance of our inventory. Under the periodic method, you wouldn't do that. You would use an adjustment at the end of the period. You'd count your inventory and then make an adjustment for cost of goods sold. But under the perpetual method, we keep an ongoing balance of our inventory and cost of goods sold. And we can do that because of the technology we have. We have the universal product code, scanners, things like that. If we went back to 50 years ago, to the 1970s, we didn't have that technology. So we had to use the we had to use the periodic method. So what we need to do here is we actually need to drop this down. And what we need to do is make sure we do the cost of goods sold entry here. Okay. So we have cost of goods sold. And for Houston, it was $23.65. And we're going to credit inventory. Now, it might behoove us, if you want to just highlight the sales revenue and the cost of goods sold, just to make it easier to do our calculation up here. You don't have to, but if it's helpful, it may make it easier to pick up the sales and the cost of goods sold when we're doing our calculation. So we'll make the sales yellow and the cost of goods sold blue. So that way, we'll be able to easily see it. Okay. All right. So now we've done the September 9th purchase. So now we're on September 10th, where we paid Sherry Company in full. Okay, so Sherry Company was our first transaction, where we purchased $4,000 worth of inventory. And remember, the freight would not be involved in any kind of discount calculation. It looks like we returned $1,100 of it. So we owe Sherry Company $2,900, right? So we have to debit Sherry Company, accounts payable, for Sherry, $2,900. Now, the question we have to ask ourselves, are we within the discount period? So if we go back and look at our original transaction, it says we get a 1% discount if we pay within 15 days. So we're paying on the 10th, so we are within the 15 days. So we're not going to pay the full $2,900. We still have to debit accounts payable for that, because if we don't, it's going to look like we still owe them $29, which we don't. So what we're going to do here is we're going to credit cash, and we're going to just put the calculation here so we know why it's not going to be $2,900. So if we have a 1% discount, it means we have to pay 99% of what we owe. So we're going to pay times 99% or 0.99, $28.71. So our discount, as expected, is $29. Now, under the periodic method, we would have an account called purchases discounts. But we're not going to have that on the perpetual method. What we're going to have is a credit to inventory, because this is actually reducing the cost of our inventory. So this is a purchase discount, purchases discount. But again, remember, under the perpetual method, we would not have an account called purchases discounts, because we're talking about tracking inventory in real time. So we would want to reflect that by paying less, by taking advantage of the discount, we are reducing the cost of our inventory. Under the periodic method, we would, of course, have to have this purchases discount account. Okay, so on the 12th, we received payment in full from Houston Company. So now we are getting the payment here because they're a customer, and this is on September 12th, so we're receiving cash. But how much cash are we receiving? Again, we have to check to see if they are within the discount period. And the discount was 3% if paid within 15 days. They're paying on the 12th, so certainly they are within that discount period. So we're only going to be collecting 97% of what they owe us, right? Okay, so it's $5,500 times 97%. So we're only collecting $53.35. So what's happening to the other $165? That's a sales discount. So under the new method for publicly held companies, we wouldn't have this account. We would have taken the discount up here. But we're following the textbook, which, is going on a company that's not publicly held, so they don't have to follow that rule. Okay? And then we're going to credit accounts receivable for the full amount they owe us. Otherwise, it's going to look like they still owe us $165, which they don't. Okay, so that's how we're going to handle the sales discount. Now on the 15th, it says we received a $200 allowance from Tearing Company. And if we go back to Tearing Company, okay, we'll see that we purchased merchandise inventory from them on the 9th. So if we got an allowance, that simply means that, okay, they're giving us $200 off the bill for some reason. We don't know why. We're not returning any merchandise, so maybe there was defective merchandise, whatever the case may be. But if they're going to reduce it from our bill, we're going to debit accounts payable, right? Because we don't owe them that anymore. And we're going to credit inventory, okay? Now, under the periodic method, we would credit purchases, returns, and allowances. But under the perpetual method, remember that this actually reduces the cost of inventory. So this is going to be a purchase return. Okay. So I'm putting it over on the side as a note. It's not actually part of the journal. Okay, we would actually credit inventory under the perpetual method. Okay, so what we'll do in the next video is we will finish the transactions and then we will do our calculation for gross profit. Thank you for your attention.